Alright, so if you've ever wanted advice from a billionaire on how to save your money, Jeff Bezos is telling people to avoid buying TVs, fridges, and cars. Basically, don't buy anything that Amazon doesn't sell. Jokes aside though, it is generally good advice to save your money in a recession. But the question is, are we in a recession? Because according to the Fed, we're not, but we're about to be, probably for the 10th time. They just told us for the first time that they now believe there's a 50% chance of a recession. Now, how do we know this? We know this because they finally told the media what they talked about inside of their super secret Illuminati FOMC minutes meeting. Now, they're not actually the Illuminati, they're the Freemasons. Jokes and secret societies aside, there is one thing that right now is holding back investments from going up in value. But once it happens, it's going to flip the markets. Because what this depends on is on the Fed and Papa Powell doing what's called the pivot. It's not actually the latest TikTok dance trend. That'd be awesome. Instead, it's referring to when the Fed changes its stance on something called the monetary policy. So today, I want to show you some new compelling data which shows exactly when the market will flip. No, you're not about to get rich quick after watching this video. Instead, I'm going to teach you how to become the mastermind of the Federal Reserve and understand exactly where we're about to go. I know that sounds super dramatic, but I promise if you stick around and smash the like button, it'll be 100% worth it. So let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the Fed. When it gets loose, the market will produce. So here's what that means. You might have heard of monetary policy. Today, we have what's called a tight monetary policy where interest rates are going up. But when the Fed pivots, that's when interest rates start to go down and we have what's called a loose monetary policy. The reason this is so important is because things like stocks, real estate, Bitcoin, and other assets will start to go up. This is because assets love loose monetary policy. So the first question is, when exactly is the Fed going to pivot? Because the answer is finally becoming a little clearer. Looking back as far as 1971, over the last 9 Fed pivots, it has taken an average of 6 months before the Fed finally starts to reverse. Now, today, we're roughly on month 7 or 8 because the Fed started to raise our rates in March of 2022. And now we're past our average, which means the Fed will most likely start to slow down. And I actually have data that proves what's about to happen. Check this out. Let's bust out the handy dandy CME Fed Watch tool, which I've shown before. Looks a little confusing, but let me break it down. It shows that right now our federal funds rate, or the interest rate, is anywhere between 3.75 and 4%. Now, the next time the Fed will raise our rate on December 14th, the range shows that there's a 75.8% chance that the next range will fall between 4.25 and 4.5%. That is exactly a difference of 0.5%, which means the next time the Fed will raise our rates, it'll be by 0.5%, which is less than their usual. And their usual has been 0.75% in the last 4 increases, so this is good news because this is the first time that they're finally slowing down. Now, I know all of this sounds insanely complicated, so to bring it back, remember, the ultimate question we're trying to figure out is, when will the Fed pivot and start to lower those interest rates so we can finally see the market go up again? The answer is probably when inflation reaches 2%. But so far, inflation's over 7%. So when is that going to happen? This is where things get so much more interesting. Enter the Taylor rule. All right, so the Taylor rule, created by famous economist Taylor Swift. Economy's not her fault. No, I'm just kidding. Just checking to see if you're still awake. The Taylor rule was created by famous economist John B. Taylor in 1992. And what this is it is the closest thing that economists have to a Game Shark cheat code that allows them to automatically create a perfect blend of job growth along with low inflation. So you can think of this as sort of like the chairman's guidebook for dummies on how to do that job. What it is it tells economists how to manage their monetary policy. In other words, how much to raise the interest rates by in order to achieve the perfect inflation target rate of 2%. So here's the secret. After this part, there's no going back. You're gonna be able to do their job better than the central banks can. The secret is that anytime there's inflation in the economy and there's a spike, the secret is to raise the interest rates by more than the inflation spike. That is it. That is that simple. There are no hidden formulas, no hidden aces up my sleeves, mostly because I'm not wearing any. So here's an example. Let's say that you're the Fed chairman and your job is to keep inflation at 2%. But then you notice that the economy had an inflation spike to 3%. Well, that's an increase of 1% to inflation. Your job would then be to immediately increase the federal funds rate by 1% to match inflation. Now, if you want to be a little extra aggressive, you might increase just a little bit more. Now, they noticed that if they had stuck to this rule like the 80s and 90s, when it was known as the period of the Great Moderation, recessions were mild. But he also noticed that during periods like the 70s, we got the lost decade. And of course, what we have now, a time with super high inflation and a time when interest rates still have not caught up. Now, if we had stuck to this rule last year, our interest rates should have spiked to 7 or 8%, but instead, they stayed near zero. Now, here is the most interesting part about this. In 2014, Mr. Taylor, the guy who created the Taylor Rule, testified in front of Congress to pass some sort of legislation that would hold the Fed accountable to this rule or to a rule like this one. He said if the Fed ever decided to deviate or not follow this rule, that they would at least have to be accountable to the public and be transparent about how they made their decisions. But to this day, after almost 8 years of trying, not a single piece of legislation has ever passed to hold the Fed accountable for how they made their moves. Now, the biggest argument was mostly from Janet Yellen, who argued it was too formulaic and that they couldn't decide on the best way to measure inflation, whether it was to use something called the CPI, the Consumer Price Index, or the PCE, the Personal Consumption Expenditures, which is the Fed's favorite way of measuring inflation because it skews the numbers a little bit lower than what inflation actually is. But either way, the point is that the Federal Reserve, a bank that is not federally owned, a private bank gets to decide the future of US interest rates. And that right there is one of the biggest mysteries in all of economics. How a private bank got to decide the outcome of the most powerful nation's economy in the world without any oversight, standard, or explanation. If I disappear, by the way, it was not by magic. No, I'm just kidding. But also I want to give credit to NPR.org for their awesome podcast with Mr. Taylor. But the point is this: when is the Fed going to pivot so we can finally start printing tendies in the market? So here's when. First, let's all agree to what a Fed pivot actually means because not everyone agrees. Some people believe it's when the Fed will slow down their rate increases or when they'll stop. But the official definition of a Fed pivot is when they'll start to reverse by lowering the federal funds rate. So for the sake of argument, let's just assume that's what it means. Easiest way to remember is when they'll use the change of heart. It's a broken card. GG. That's how I remember. Now, instead of giving you my opinion on when I think this will happen, I don't think my opinion's all that valuable. So instead, let me give you the data based upon certain criteria from people who actually get paid to do this for a living, and then you can decide for yourself. But according to a CNBC survey, which consists of economists, analysts, and strategists, they're expecting the federal funds rate to finally reach a peak point in March of 2023, next year. That's when it'll reach an average of 4.83%. That's the peak point. They expect that rates will last at that high point for about 10 months. That would take us to December 2023 or as late as January 2024. They're looking at the economy to do 3 specific things. First, they want to see the core PCE, which remember is a fancy way of measuring inflation, to average 2.6% or lower for at least 5 months. Now, right now, our core PCE is way above 2.6% on average. And by the way, we don't actually get to see October's PCE until December 1st of this year because economic data is always behind, but know that when it comes out, it'll probably be way higher than 2.6% because rents are still too high. Number 2, they want to see unemployment at least 5.3%, which is interesting because today our unemployment is 3.7%, way better. So does that mean the Fed wants to see more people fired? No, it just means that before they start to revive the economy and lower interest rates, they need to see jobs suffer and disappear. Right now, our jobs market, if anything, is too good. It's too hot. So of course, they're not going to use Monster Reborn on a field that's full. Know what I mean? And number 3, this survey shows that they want to see a GDP of negative 2.2%. So what does that mean? This year, our GDP is going to finish the year roughly at a positive 1.5%, which means next year, the next 4 quarters need to average a negative 2.2% before the Fed will pivot. We are very far away from that kind of pain, but assuming that things play out the way this survey suggests they might, then the earliest the Fed would pivot is theoretically December 2023 or January 2024. Now, all of this is sort of my long way of saying that based on this data, it doesn't seem like the stock market is gonna go up anytime soon because the stock market doesn't want to, quote, fight the Fed until it sees the Fed starts to pivot. Now, I'm not saying that this is exactly how things are going to play out, but generally speaking, this is how things have historically played out in the past. But in no way, shape, or form am I saying that anyone should ever base their investment decisions on any of this data. Personally, I've always said that what works best for me is a long-term investing strategy and investing into broad market index funds and ETFs like VTI and VOO, again, for the long term. But I do think it's valuable to understand this stuff because I found the more I learn something and the more I know about something, the less afraid I am of it, and I'm more prepared to make better decisions in the future. At the end of the day, no economist knows whether the Fed will pivot in the first half of next year or at the end of next year. No one knows when this magical Fed pivot will happen. That's why ultimately the general rule of thumb is that time in the market beats timing the market. That's why I'm personally staying invested. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. Links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.